At exactly 8:00 p.m. Eastern Time, while most investors were focused on Western price screens showing silver near $87, another market reopened and sent a message that demands serious attention. Shanghai returned from a 9-day closure and immediately priced physical silver roughly $10 to $12 higher than the Western benchmark. That is not a routine fluctuation. That is a structural signal. When the world's largest physically delivered silver market values metal materially above a futures-driven benchmark, professionals do not dismiss it. They investigate it. Because in commodity markets, sustained regional premiums often reveal friction in supply flows, tightening inventories, or shifting demand dynamics. The question is not whether a spread exists. The question is why it exists and whether it persists. What we are witnessing is not simply a price divergence. It is a stress test of global silver price discovery. On one side, a highly leveraged futures market. On the other, an exchange where contracts require real metal in real warehouses. When those two systems begin to separate, it signals that something beneath the surface is changing. Today's move is not about excitement. It is about structure, inventory levels, export controls, delivery participation, and sustained global deficits are converging at the same moment. And when multiple structural forces align, markets do not ignore them indefinitely. They adjust. This is where disciplined financial analysis matters. Not speculation, not hype. Data. Because in commodities, math eventually outweighs narrative. When a major commodities exchange reopens after 9 days offline and immediately prices silver $10 to $12 above the Western benchmark, that is not background noise. That is a signal. And in financial markets, signals matter most when they challenge the prevailing narrative. While futures screens in New York were printing silver near $87, Shanghai's physically delivered market was implying a valuation closer to the high 90s. The question serious investors must ask is simple. Why would buyers in a physically settled market willingly pay that much more? In a normally functioning global commodities system, price discrepancies between major hubs are quickly arbitraged away. If silver is cheaper in one region, traders buy there, ship the metal, and sell into the higher-priced market. That process compresses spreads and restores balance. The existence of a 10+ premium suggests that this balancing mechanism is not operating smoothly. Either the metal cannot move efficiently, the cost and delay of moving it are rising, or local demand is strong enough to absorb supply at elevated prices. None of those explanations are trivial. It is also important to recognize the structural difference in price discovery mechanisms. Futures markets can reflect leverage, positioning, and hedging flows that may not immediately require physical delivery. A physically delivered exchange does not have that flexibility. When contracts approach delivery, real metal must be available. That requirement forces the price to clear at a level where actual supply meets actual demand. If that clearing level is materially above a paper benchmark elsewhere, it introduces tension between the two systems. The premium does not automatically mean Western prices are wrong. Regional taxes, currency dynamics, and import costs can influence spreads. But when the premium widens sharply upon reopening and follows weeks of tight inventory conditions, it becomes part of a broader pattern. Persistent divergence between physical and paper pricing often precedes periods of adjustment. Markets can tolerate small spreads. They struggle with structural ones. The core issue is not a headline price difference. It is what that difference implies about liquidity, accessibility of supply, and the true clearing price of physical silver when buyers must take possession rather than roll a contract forward. In commodities, sustained premiums are rarely random. They reflect pressure building beneath the surface. When two major financial centers price the same global commodity differently at the same moment, professionals do not ignore it. They investigate it. A widening gap between Western futures pricing and Shanghai's physically delivered silver market is not just a regional quirk. It forces a deeper examination of how price discovery is actually occurring. The core question becomes unavoidable. Which market is reflecting immediate physical reality, and which is reflecting positioning, leverage, and expectations? Western benchmarks are heavily influenced by futures contracts, where the majority of participants never intend to take delivery. These markets serve essential functions: hedging, liquidity provision, risk transfer, but they also allow significant price exposure with relatively small capital outlays. That leverage amplifies both upside and downside moves, sometimes detached from near-term physical flows. When open interest expands rapidly, or when macro funds adjust exposure based on interest rates, geopolitics, or currency shifts, futures pricing can move independently of warehouse inventory levels in the short term. By contrast, a physically delivered exchange imposes discipline. If a participant stands for delivery, metal must be available. That creates a different form of accountability in pricing. When buyers in such a market consistently accept higher prices to secure physical supply, it signals that the metal itself, not just exposure to it, has value beyond the future's quote. This is where divergence becomes meaningful. A $10 gap is not symbolic. It reflects differing constraints. The tension between paper and physical pricing is not new in commodities, but it becomes financially significant when inventories are tight and global trade flows are experiencing friction. If arbitrage is slow or costly due to regulatory delays, logistics bottlenecks, or export controls, the mechanism that normally aligns prices weakens. The result is a visible separation in benchmarks. Importantly, divergence does not imply dysfunction overnight. Markets can operate with spreads for extended periods. But when a physically settled market repeatedly prices above a futures-dominated benchmark during a time of inventory drawdowns and rising delivery interest, professionals recognize a shift in underlying balance. The conversation moves from speculative momentum to structural supply constraints. In commodities, sustained divergence often signals that one side of the market is underestimating real-world demand pressures. Policy changes rarely move commodity markets overnight, but when they alter the flow of physical supply at the source, they reshape the landscape in ways that compound over time. China's decision to restrict silver exports to a whitelist of 44 state-approved enterprises is not a headline designed for short-term volatility. It is a structural shift in how global silver moves, and when a country that refines an estimated 60 to 70% of the world's silver tightens administrative control, the implications ripple outward. This is not a formal export ban. It is more nuanced and arguably more effective. By requiring government approval for each outbound shipment and reducing the number of eligible exporters from hundreds to a curated list, the system introduces friction. In commodities, friction is not abstract. It translates into time delays, higher transaction costs, and uncertainty for counterparties. When shipments take 2 to 4 additional weeks to clear paperwork, supply chains adjust cautiously, buyers hedge differently, inventories are hoarded more defensively, premiums begin to widen. Markets function efficiently when supply is predictable and responsive. When administrative bottlenecks slow that responsiveness, even without reducing total annual output, liquidity tightens in destination markets. Traders who previously relied on flexible export channels now face concentration risk. If 95% of former participants are no longer authorized to ship, pricing power consolidates. Fewer channels mean less optionality, and less optionality often means higher clearing prices during periods of strong demand. This approach mirrors broader commodity policy strategies where control is exercised through licensing rather than quotas. It allows authorities to calibrate flow without publicly declaring reductions. The impact is subtle but cumulative. Each delayed shipment reinforces the perception of constrained availability. Each approval adds uncertainty to delivery timelines. For industries reliant on silver, solar manufacturing, electronics, automotive components, predictability matters as much as price. The financial significance lies in how quickly markets reprice when supply flexibility declines. Investors often focus on mine production statistics, but administrative throughput can matter just as much as geological output. When a dominant refiner slows export velocity even modestly, the global system absorbs the shock unevenly. The result is tighter spreads, regional premiums, and greater sensitivity to demand spikes. In commodity markets, control over flow can be as powerful as control over volume. Inventory levels are the quiet backbone of any commodity market. They rarely dominate headlines until they do. When exchange inventories fall to decade lows while open interest and large short positions remain elevated, the market's tolerance for surprise shrinks dramatically. That is where sensitivity begins. And sensitivity in commodities is often the precursor to volatility. A warehouse report showing declining silver stocks may appear incremental at first glance. A few metric tons here, several 100,000 ounces there. It seems manageable. But inventory is not just a number. It is a buffer. It represents the cushion between steady demand and sudden stress. When that cushion thins, the system becomes less forgiving. A delivery cycle that would normally pass unnoticed can suddenly carry weight. A single participant deciding to stand for physical settlement rather than roll forward can exert outsized influence. Layer on top of that an aggressive short position in a physically delivered exchange. Short exposure by itself is not unusual in futures markets. It provides liquidity and hedging functionality. However, when the nominal short position exceeds readily available inventory, the dynamic changes. The market transitions from theoretical exposure to potential logistical challenge. If even a fraction of counterparties demand delivery simultaneously, inventory must be mobilized quickly. In tight conditions, that mobilization can push prices higher as available metal becomes more valuable. What makes this environment particularly delicate is the interaction between psychology and math. Traders monitor warehouse stocks closely. Industrial users watch delivery statistics. When visible inventory trends downward over successive sessions, confidence in abundance erodes. Participants begin to secure supply earlier than necessary, accelerating the tightening cycle. This feedback loop can be subtle at first, but intensifies when reinforced by broader structural deficits and regulatory friction. Importantly, low inventories do not automatically trigger disruption. Exchanges have mechanisms to facilitate orderly settlement. Large positions can be rolled, negotiated, or offset, but the margin for error narrows. The system relies on coordination, and timely supply flows to function smoothly. When inventories sit near multi-year lows, each new demand impulse carries greater weight. Markets with thin buffers do not collapse easily, but they do react faster and more sharply when pressured. When registered inventories decline at the same time delivery interest rises, experienced market participants pay attention. Registered silver represents the portion of exchange warehouse stocks that is officially available to satisfy futures delivery. It is not theoretical supply, it is the pool designated and ready to meet contractual obligations. When that pool shrinks meaningfully while open contracts approach first notice day, the system enters a phase where positioning decisions carry greater consequence. Delivery windows are often routine. Many traders roll contracts forward, rather than take physical settlement. That rolling activity keeps the futures curve liquid and prevents stress from concentrating in a single month. But when a larger than normal percentage of participants elect to stand for delivery, the exchange must allocate actual metal from registered inventories. If recent sessions have shown persistent drawdowns, hundreds of thousands of ounces per day, the cushion narrows quickly. This is where numbers matter more than narratives. A one-third reduction in registered stocks over several months changes the ratio between open interest and deliverable supply. The higher that ratio climbs, the more sensitive pricing becomes to marginal shifts in participant behavior. Even if only a fraction of contract holders demand delivery, the optics alone can influence short-term volatility. Traders recalibrate risk. Shorts hedge more defensively. Premiums widen in secondary markets. It is also critical to distinguish between total inventory and registered inventory. Exchanges often report larger overall warehouse totals, but only the registered portion is immediately available for contract settlement. Eligible stocks can be converted to registered status, but that process requires owner consent and may not occur instantly. Timing becomes relevant when first notice day approaches and contracts must be matched with metal. None of this guarantees a disorderly outcome. Futures exchanges have long-standing mechanisms to manage delivery flows, and most cycles conclude without disruption. However, when declining registered inventories intersect with elevated delivery demand and global supply tightness, the market's tolerance for imbalance decreases. In such an environment, price can become the adjustment mechanism. Markets rarely signal stress with alarm bells. They signal it through tightening spreads, accelerated withdrawals, and heightened sensitivity to each new delivery statistic. Structural deficits rarely create immediate drama. They operate quietly year after year, tightening the underlying balance between supply and demand until the system becomes less resilient. In the case of silver, multiple consecutive years of global supply shortfalls signal that consumption has consistently exceeded newly mined and recycled output. That imbalance does not automatically translate into explosive price action, but it steadily erodes surplus capacity. And surplus capacity is what stabilizes markets during shocks. Silver occupies a unique position in the commodity spectrum because it is both a monetary asset and an industrial input. Demand does not come from a single channel. Solar manufacturing, electronics, electric vehicles, medical applications, and semiconductor fabrication all require physical silver in measurable quantities. At the same time, investors view it as a store of value during periods of currency volatility and geopolitical uncertainty. When industrial demand remains firm while investment interest strengthens, deficits compound. A projected annual shortfall of tens of millions of ounces might appear modest relative to total global supply. But what matters is not just the size of one year's gap, it is the cumulative effect. Each deficit year reduces above-ground inventories unless offset by price-induced demand destruction or accelerated recycling. If those adjustments do not occur quickly, the market enters a phase where buffers thin and sensitivity rises. Importantly, structural deficits tend to magnify the impact of policy changes and logistical friction. When supply already trails demand, even small disruptions, export restrictions, refinery slowdowns, shipping delays, have outsized influence. The market cannot easily absorb shocks because it is operating without surplus slack. That is when premiums emerge regionally, and when delivery participation becomes more consequential. Investors sometimes underestimate the significance of persistent deficits because commodity prices can remain range-bound for extended periods despite tight fundamentals. But markets are not static. They reprice when incremental pressure reaches a threshold. Structural imbalance acts like tension building in a system that appears stable on the surface. It may not produce daily volatility, yet it alters the risk profile beneath the price chart. The financial relevance of repeated supply shortfalls lies in resilience. A market in surplus can withstand uncertainty. A market in deficit must adapt through higher prices, reduced consumption, or new supply investment. Until one of those adjustments materializes meaningfully, the underlying pressure remains. Markets rarely resolve structural tension in a single session. They move through phases: signal, reaction, adjustment, recalibration. The reopening premium in Shanghai, the inventory drawdowns, the delivery pressure in Western exchanges, none of these should be interpreted as a one-day verdict. The more disciplined perspective is to view them as components of an unfolding process. And processes, especially in commodities, demand patience and precision. Opening premiums after extended closures can exaggerate urgency. Institutional buyers return, hedges are adjusted, orders that accumulated during the break are executed quickly. Spreads can widen sharply before stabilizing. The critical question is not what happens in the first trading hour, but what persists into the second week. Does the premium compress as arbitrage activates, or does it remain elevated despite clear profit incentives? Persistence carries more weight than headlines. The same applies to delivery cycles. Elevated delivery participation during one contract month may reflect temporary positioning decisions rather than systemic strain. Exchanges are designed with mechanisms to absorb short-term imbalances. Margin adjustments, roll incentives, warehouse reclassifications. These are part of normal functioning. What professionals monitor is repetition. If tight inventories and strong delivery demand recur across consecutive cycles, the narrative shifts from anomaly to pattern. Policy friction operates similarly. Export licensing delays may initially create uncertainty without dramatically altering annual supply totals. Over time, however, even modest administrative slowdowns can reshape trade flows and inventory management strategies. Buyers adapt cautiously. They secure material earlier, hold larger buffers, and pay premiums for certainty. That behavioral shift reinforces the original tightening. This is why structural analysis outweighs emotional reaction. Commodity markets are ecosystems. Inventory levels, policy constraints, industrial demand, and investor sentiment interact continuously. No single data point determines direction. Instead, convergence matters. When multiple pressure points align over weeks and months, price gradually becomes the adjustment mechanism. The disciplined approach is to track metrics rather than narratives: warehouse stocks, delivery percentages, export approval timelines, industrial consumption trends. If these variables continue reinforcing one another, the process advances. If they stabilize or reverse, tension eases. Sustainable repricing is rarely explosive at the outset. It is incremental, data-driven, and cumulative. Professionals focus on trajectory, not noise. Silver's current landscape is not defined by a single premium, a single delivery cycle, or a single policy change. It is defined by convergence: declining inventories, tightening export controls, rising delivery interest, and consecutive global supply deficits are unfolding simultaneously. That combination reshapes risk. Markets can operate with tension for extended periods, spreads can compress, delivery cycles can normalize, administrative friction can ease. But when structural pressures align across regions and exchanges, professionals pay attention, not emotionally, but analytically. The responsibility now is not to react impulsively, but to monitor the data with discipline. Watch warehouse inventories, observe delivery participation, track export approvals, study industrial demand trends. Markets reward those who understand process over those who chase headlines. This is financial education grounded in publicly available data. Verify the numbers, challenge the assumptions, make decisions based on structure, not sentiment. In commodities, preparation always outperforms surprise.